A typical candlestick has one body and two shadows. The body shows the open and close prices. In bullish candles, the close price is higher than the open price. In bearish candles, the close price is lower than the open price. To distinguish the bullish and bearish candles from each other, they are displayed with different colors. Usually, bullish candles are white or green, and bearish candles are black or red. In both of the bullish and bearish candles, the upper shadow shows the high price, and the lower shadow shows the low price. That was the anatomy of the typical candlesticks in simple words. However, candlesticks can have several different shapes and patterns. Each shape and pattern has a different signal that tells the traders what to do. Candlesticks are great indicators. Many of the professional traders use nothing but candlesticks to trade. Doji. Doji forms when the open and close prices are virtually equal. A doji candlestick looks like a cross, inverted cross or plus sign. Doji means that bulls or buyers, and bears or sellers are well matched, and none of them is stronger than the other one. Therefore, doji means indecision. It means, after a doji, the trend can be continued, reversed, or starts moving sideways. If you have a position, you'd better to close it, and collect your profit, when a doji is formed. Look how many doji candles we have on Euro-USD daily chart. Many of them worked as a reversal signal. The price continued its way after many others. The price kept on going up after this doji. The price reversed after a few doji candles formed here. The majority of Japanese candlestick signals are reversals. Hammer and hanging man. Hammer and hanging man are reversal candlestick signals. They have long lower shadows and small bodies. Surprisingly, it doesn't matter whether these candles are bullish or bearish. When you find one on a downtrend, it is signaling that the trend is near to an end. We call it hammer when formed on a downtrend. A similar candle on an uptrend signals that the uptrend is close to an end. We call it hanging man when formed on an uptrend. Although these candles are known as reversal signals, it is better to wait for a confirmation when they are formed. It means, when a hanging man is formed on an uptrend, we have to wait for a bearish candle to form after that to go short. It is the same with hammer. When formed on a downtrend, we have to wait for a bullish candle to form to go long. Inverted hammer and shooting star are the inverted types of hammer and hanging man. However, they are weaker signals. They also need confirmation. High wave. High wave is a doji candle with long upper and lower shadows. A group of high wave candles form a strong reversal signal. Candlestick patterns. Engulfing pattern. The engulfing pattern forms by two candles. There are two kinds of engulfing pattern. In bearish engulfing pattern, a small candle with a bullish body is completely covered by the body of the next candle, which has a big bearish body. Bearish engulfing pattern on an uptrend is a strong reversal signal. That means the uptrend is ended and will reverse. It is a good chance to go short. In bullish engulfing pattern, a small candle with a bearish body is completely covered by the body of the next candle, which has a big bullish body. Bullish engulfing pattern on a downtrend is a strong reversal signal. That means the downtrend is ended and will reverse. It is a good chance to go long. Engulfing pattern is stronger if the second candle covers the body of more than one candle. Dark cloud cover. Dark cloud cover is a bearish reversal pattern. Like bearish engulfing pattern, it forms with two candles. The second candle opens a little above the close price of the first candle and goes down and closes a little above the open price of the first candle. Dark cloud cover forms on uptrends and is a strong reversal pattern. Piercing line. Piercing line is the bullish form of dark cloud cover pattern. It forms on downtrends, and is a reversal pattern. The second candle opens a little below the close price of the first candle, and goes up and closes a little below the open price of the first candle. Harami. Harami is another reversal candlestick pattern that forms by two candles. There are two kinds of harami. Bullish harami forms on downtrends, and bearish harami forms on uptrends. Bullish harami is a candlestick chart pattern in which a large candlestick is followed by a smaller candlestick, whose body is located within the vertical range of the larger body. In terms of candlestick colors, the bullish harami is a downtrend of negative colored, or black candlesticks, engulfing a small positive or white candlestick, giving a sign of reversal of the downward trend. Bearish harami is a candlestick chart pattern in which a large candlestick is followed by a smaller candlestick, whose body is located within the vertical range of the larger body. In terms of candlestick colors, the bearish harami is an uptrend of positive colored, or white candlesticks, engulfing a small negative or black candlestick, giving a sign of reversal of the upward trend. The harami is not a reliable reversal pattern, but it is a useful warning. When a harami forms while you are already in a position, you should move your stop loss to a proper position, not to lose your profit if the trend reverses. Harami means pregnant. The reason is that the first candle, with the second one, which is smaller, look like a pregnant woman. The smaller the second candle, the stronger the harami signal is. When the second candle is a doji, the pattern is called harami cross, which is stronger than the regular harami. Morning and evening star pattern. Morning star is a three-candle pattern. This pattern forms on downtrends. The first candle should be a bearish candle, with a considerable body. The second candle is a small candle, that is formed lower than the first one. This candle can be bearish or bullish. The third candle is a bullish candle, that is formed higher than the second one, and its body covers a significant portion of the first candle. Morning star is called evening star when formed on an uptrend. The effectiveness and potency of the morning star and evening star patterns as reversal signals is dependent on some special factors that have to be considered. The distance or gap between the morning or evening star with the first and third candlesticks is very important. The bigger the gap, the stronger the signal. The degree of the coverage of the first candlestick by the third one is also important. The bigger the coverage, the stronger the signal. Sometimes, the morning or evening star is a doji candlestick. Again, in this case, the most important thing is the gap between the first and third candlestick and the doji. Sometimes, The morning or evening star is a very small candlestick with small or no shadows. The gap is so big, and even none of the candlestick shadows cover any part of the morning or evening star. This pattern is called abandoned baby, which is a very strong reversal signal. Because of the high volatility, this pattern is very rare in the Forex market, and can only be seen in bigger time frames, but it can be seen in the stock market in smaller time frames, like 1 hour. Abandoned baby can be seen both at the top of an uptrend or bottom of a downtrend. Tweezers. Tweezers is made up of two candlesticks that are next or so close to each other. They have identical highs at the top of the market, or identical lows at the bottom of the market. The tweezers usually becomes formed by the candlestick shadows, but it can also be made by the bodies of the shaven candlesticks. The two candlesticks that formed tweezers can have small bodies, like Doji and hammer candlesticks. Tweezers cannot be considered as a strong reversal signals, and it needs confirmation, but you have to be careful when you see a tweezers signal. The longer the shadows, the more weight we should give the tweezers. Tweezers that are formed right under resistance lines, or above the support lines, are important, especially when they are made up of two doji candlesticks. The longer the shadows, the more potent the tweezers signal. It is also possible that you see a few or even several candlesticks between the two candlesticks that form the tweezers pattern. Even in this case, you should not ignore the tweezers as a potential reversal signal. When there are several candlesticks between the two that make the tweezers pattern, they may form double tops or double bottoms patterns that show the levels of resistance or support. How to make money with the candlesticks. First, you have to wait for the candlestick signals and patterns to form completely. Then you take the proper position and set the stop loss. It is strongly recommended to wait for the confirmation candle to form. With the candlestick signals that need confirmation, you take the position after the confirmation candle. In case of long positions, the stop loss has to be below the open price of the confirmation candle. In case of short positions, the stop loss has to be set above the open price of the confirmation candle. This is how you trade the candlestick signals and patterns. We will have more videos about this